Hello, this is Dave Myers with Paper Trail Financial. Today I have a free tutorial regarding a way to measure the effectiveness of the collection of your business's accounts receivable. Speedy collection of receivables is a key component of effective cash flow management. The shorter the time span between recording a sale and collecting the revenue, the more cash is available to the business for its own obligations and growth. Business owners need to be especially aware of timing of receivable collections. One way to measure how quickly receivables are being collected is the days sales outstanding ratio, or as it's commonly called, the AR days ratio. The Accounts Receivable Aging Report in Quickbooks provides information on existing outstanding customer balances, but it doesn't have any information regarding how quickly they're paid. The days sales outstanding ratio is a simple formula using the balance sheet and income statement to calculate the average amount of time it takes to collect on sales made on credit. The calculation of the AR days ratio consists of two simple formulas. Receivables turnover is credit sales divided by the average receivables balance. The ratio illustrates how many times receivables have turned over within a given time period. Using the turnover ratio, we're able to calculate by days how long it takes on average to collect from customers. The ratio takes the 365 days in a year, divides it by the receivables turnover ratio, the amount of time in the year. If it seems complicated, it's really not. The days sales outstanding ratio is only a couple of simple division problems using information you already have in your QuickBooks file. The first thing we need to do is to generate the balance sheet report. Since this is a sample file, it's dated December 15, 2013. I'll adjust the starting date to December 16, 2012. We also want to view the report by the month. Now we'll export the report to Excel. I'll name the Worksheet tab since I'll be referring back to this sheet later, and I'm going to clean up the columns. Going back to QuickBooks, we need to generate the profit and loss statement. I'll modify the dates to match the balance sheet. We'll also modify this to use monthly columns. Because the ratio involves only sales on credit, I'll filter the report by transaction type, multiple transactions, and we'll use invoices and credit memos. These are the forms in QuickBooks that directly affect the AR account. Since QuickBooks can't export to an open Excel file, we'll export this report to another new workbook, then cut and paste the report into the first workbook. Once we have both reports in a single Excel file, we can create a new sheet and enter the formulas. I'll widen the columns and enter the headings. We only need two inputs, the total sales made on credit and the average account receivable balance over the past year. From that, we can calculate the amount of times receivables turn over in a year and how many days on average it takes. First, I'll grab the modified credit sales total from the income statement. And now we'll calculate the average receivable balance over the last 12 months. With these two numbers, we can calculate the ratios. The AR turnover ratio is credit sales divided by average receivables. The AR days ratio is the 365 days in a year divided by the number of times receivables turn over in a year. In this case, we show an AR days ratio of just under 21 days. If the business primarily provides terms of net 30, then the conversion is considerably strong. If the terms offered are net 15 or payment on demand, then there's room for improvement. If you don't feel comfortable working in Excel, you can look at the balance sheet and income statement side by side and just eyeball the figures for their proportion. You want to look at both the total AR figure and total income. Here, total income appears to be about 10 times larger than the AR balance. 365 days divided by 10 equals 36.5 receivable days. Keep in mind this method is not as accurate. It's only using the existing AR balance, not the total average, and it uses total sales, not just sales on invoices. This receivable days ratio shows us the average turnover time for a year, but it doesn't show fluctuations in AR collections, which can have a strong influence on cash flow. In order to look at the figures monthly, we can copy the dates, sales, and receivable information to a new sheet and recalculate both the AR turnover and AR days ratio for each month. Here we want to paste special and select values, so we're only copying the numbers and not the formulas from the statements. The formulas remain roughly the same. The AR turnover ratio is monthly credit sales divided by monthly AR. Since we're breaking down the figures by month, rather than divide by 365, we'll use 30 days divided by the turnover ratio for the monthly AR days ratio. The monthly AR days show how receivable collections have fluctuated over the past year. We can add some conditional formatting to highlight average AR collection periods beyond 30 days. Here you can see there were two problem months where ARs exceeded sales, specifically October, which saw credit sales decline 3 straight months, but an increase in receivables.